Today I want to talk to all business owners out there, and I want to talk to you about my favourite subject, tax, and particularly how to legitimately avoid tax. Why do we legitimately avoid tax? Because frankly, tax is the greatest financial obstacle in our world. It's the thing that stops you keeping money. Accumulating wealth is about keeping money, not about earning it. So, how do you keep more? As a business owner, what are the legitimate ways you can avoid tax? And I want to break these down into three separate categories: short-term tax savings, longer-term tax savings, and other tax savings that are a little bit more complex, and too complex indeed to go into in this short video, but something that we will talk about briefly and add to later in our master classes to come. So, short-term tax breaks, small benefit exemption. This is the ability to pay any employee up to €1,500 in a year and do so tax-free. Bear in mind, employees are just as likely to be the business owners and their families as regular employees. The second thing to talk about is subsistence allowances. I can't tell you how surprised I am during my consults talking with business owners who aren't using subsistence allowances. Known as civil service rates, these are allowances any employer can give any employee who has to be away from their normal place of work on business for 5 hours in a day, 10 hours in a day, or indeed overnight. They are unvouched, they are civil service rates, and if you're ever audited down the line by the revenue and someone from the revenue is sitting in your front office looking through your books, they will be claiming these allowances. You should be too. The third thing to talk about is the loaned goods rule, or sometimes referred to as the 5% BIK rule. What is this? This allows a company to loan certain assets to employees at a 5% of the value of the asset per annum benefit in kind, BIK. Example, television. You go out tomorrow and pay $2,000 for a telly. You've had to earn $4,000 as the business owner, more than likely, to put $2,000 in your pocket to go buy the telly. If you let the company buy the telly and it's VAT registered, it pays €1,600 for the telly, and it can lend it to you at 5% of that cost. That's €80 a year. So instead of the company paying €4,000 to you to buy the telly, it pays €1,600 and you pay €80 a year. Far less expensive. The final thing is electric vehicles. Currently, the OMV, the original market value on which benefit in kind on all company vehicles is levied, is reduced by €45,000 for electric vehicles. Now, while it is true that €45,000 is a 2025 rate, expected under current rules to drop to €20,000 next year, €10,000 the following year, and disappear the year after that, my view is it's likely to be extended because it has already been extended. The €45,000 OMV was supposed to disappear last year, but has been extended, and I think the reason it's being extended is Ireland Inc. is not hitting its EV targets. If we do not hit our EV targets, we could end up paying a €3 billion fine to the European Union in 2030. So the fact that these allowances are costing the revenue €50 to €60 million a year is likely to be extended, because that €50 to €60 million a year is far less than €3 billion in 2030. Finally, in the short-term category, I want to talk to you about hiring the family. There are many entrepreneurs and business owners out there who have roles available within their company that their family can provide, either spouses or indeed children. Now, certain rules apply here, and those rules must be adhered to, but broadly speaking, bear in mind that every member of your family has their own tax credits. If you are, for example, have a college child going to college and you're paying 10,000 a year for them, again, that's costing you 20,000 a year in income to pay the tax on it, to pay out for the college costs, some of which are tax deductible, of course. But if you give the same child a job and pay them 10,000 a year, because that's under the tax credit limit, they will pay zero tax on it. So small benefit exemptions, subsistence allowances, loaned goods, electric vehicles, hiring the family, all of these are legitimate methods of reducing the tax liabilities on the money you take from your business. And as I said, all short, relatively short term. Longer term, well, the sharpest tool in the box, and it won't surprise those regular listeners or viewers that I say this, the sharpest tool in the box is the retirement fund. Broadly speaking, the benefits of a retirement fund contributed to by your company is the company can pay the contributions and write those off against corporation tax. That money leaves the ownership of the company as protected from creditors, so there's a commercial de-risking. That money arrives as your ownership or the beneficiary's ownership with zero tax liability. And between now and the day you dip your hand in the cookie jar, now and the day you decide to spend the money, all income derived from investment is tax exempt and all capital gain is tax exempt too. At a maximum, under the current under the current standard fund threshold, the maximum a retirement fund can be is €2 million, set to rise to €2.8 million in the next few years. So bear in mind too that that is a personal allowance. So if your spouse works in the business, that €2.8 million maximum can go to up to €5.6 million. Other long-term reliefs, entrepreneurial relief. You've heard me talk about it before, perhaps. Broadly speaking, it allows you to sell or liquidate qualifying business assets up to a value of €1 million and pay only 10% tax on it, where normally the tax would be 33%. This too is a personal allowance. So if there's 2 of you, or 3 of you, or 4 of you, the potential tax reliefs are growing in line with the numbers being added. This is where planning comes in, because a lot of businesses out there have one shareholder, even though 2 or more of family members are active within the business. The qualifying criteria, 3 years ownership, 3 years working within the business. But if you can tick those boxes, you can qualify for the €1 million at 10%. If your spouse ticks the same boxes, he or she qualifies for another €1 million. If your child ticks those boxes, he or she qualifies for another €1 million, and so on and so forth. And finally, from a long-term perspective, we've got retirement relief. Similar to entrepreneurial relief, however, longer-term qualification. 10 years share ownership, 10 years working within the business, and in this case must be 55 years or older. If you tick those boxes, you can sell or liquidate your share in a private business going concern for up to €750,000 and pay zero tax liability. For 2 of you, that's €1.5 million. So if you and your spouse are involved in your business, between the pensions, €2.8 million, the entrepreneurial relief, €1 million, the retirement relief, €750,000, double that, the total is €9.1 million as a maximum, with a total tax liability of €200,000. Planning is important. Making sure you tick the qualifying boxes is vital. But if you can, then that's the maximum amount potentially allowable to be taken from companies. And as you can see, a very, very tax efficient manner. So far, short-term potential benefits delivered by small benefit exemption or SBE, subsistence allowances, loaned goods, electric vehicles, hiring the family. Longer term benefits delivered through retirement funds, through entrepreneurial relief and through retirement relief. Now, while it's relatively easy to outline these things to you, it must be said that it is vitally important that they're planned properly. There are nuances here. There are different qualifying criteria. For example, entrepreneurial and retirement relief and the retirement funds don't apply to holding companies, only to trading businesses. So I don't want you to go off half-cocked and think you can deliver these benefits immediately simply by following my words. It requires planning. But that planning is available, and I'm delighted to announce it's even now available from Ask About Wealth through a financial plan consult. Check out our website to find out more. I said there's a third category, and that third category, let's call it other tax breaks. What other tax breaks are there that aren't included in the short and long-term ones I've listed? Well, tax breaks can be delivered through R&D research. Tax breaks can be delivered through a thing called share capping. Tax savings, can be delivered by changing the shareholding of a business well in advance of that business perhaps mushrooming in value. These are too complex areas to go into in any great detail, and they're not an exhaustive list. More and more tax breaks exist that simply I don't have time to go into here. But what I am encouraging you to do is work on tax planning. As I mentioned at the start, tax is the greatest obstacle to you and me achieving any financial ambition we care to mention. Every time we earn a penny, we pay tax. Every time we spend a penny, we pay tax. Every time we give a penny to our children, they pay tax. Every time we save money, we pay tax. Or invest money, we pay tax. Tax is inevitable, yes, but the rates of tax, the amount of tax you may pay in the future is not inevitable. Taking action now, putting proper structured planning in place has the potential to lower tax liabilities. And that's, I suppose, the message I want to leave you with. Tax planning, the avoidance of tax, the minimisation of tax is only achieved by looking into the future, asking what's likely to happen and what can I change today that will de-tax those events. That's where a financial planner and tax planner earn their salt. Is it possible to DIY tax planning? Well, sometimes it might be. But even if you know what I know, even if you know what your tax consultant knows, where will you find the time to put these plans into action? The simple truth, as proven by the Revenue's regular reports to the PAC in this country, is that we are all overpaying taxation. We are not finding the time to work on taxation, and we should be. There will be fees associated with tax planning, but I assure you that the fees will be considerably less than the benefits. Good luck with your tax planning in the future.